But thank you for taking the time out, Mihir. And just such a perfect day to get you. We've seen the non-farm payroll data come out. And the interesting thing is that maybe earlier the market wanted weak data to lead to some heavy central banking action for the markets to do well. Now the market seems to be worrying that yes, there will be central banking action, but growth seems to be a problem, and therefore there is a worry out there too. How do you look at this curious set of events?
Good morning, Neeraj. Thanks for having me. Always a pleasure to be on your show. So market always wants Goldilocks, right? But you may not get Goldilocks all the time. So market wants the US economy to slow down just enough so that there is a justification for rate cuts, but not too much that it goes into a recession or something like that. So that's something that is wishful thinking. My base case is that the US continues to slow down because if you look at the overall macro picture in the US, the excess savings of the households has actually been depleted. The excess savings that we saw because of the COVID stimulus, that is depleted. So you can't continue to expect the same kind of traction in retail sales, services, etc., that we have seen in the last 2-3 years. And the farm rolls data and the other data points in the last few days that we have seen, especially on the job creation side, there is a distinct sign of slowdown. So I think my base case is that the US continues to slow down as far as the retail consumption, etc., is concerned. So you may see some downgrades on that space. On the flip side, that may not immediately lead to technology spending because corporates have still made a lot of money. You are seeing earnings resilience in the tech sector, at least so far. So you may not see the immediate impact for Indian IT services. But for the global economy, as far as commodities are concerned, as far as general goods and services trade is concerned, you can see some slowdown.
Got it. Okay. So, Mihir, there is a slew of central banking decisions. I think we have ECB this week and the Fed may be following some of the European central banks. Based on your base case of the US continuing to slow down, but we're also looking at Fed action, even if it's just 25 bips or 25 basis points in the current policy, but maybe some more in the times to come. What is your stance on risk assets in general? We'll come to India valuation specifically, but I remember you telling me that central banks have been the driving force behind market moves ever since COVID lows. Does that continue to be the case, or would you be skeptical on risk assets?
I would be a little circumspect, but not necessarily for, say, flows to emerging markets, because what the banks are trying to do is make sure that the dollar does not appreciate too much or depreciate too much. But if the pace of rate cuts in the US is faster than the rest of the world, then you might see a gradual depreciation of the dollar against the major currencies, which can lead to a little bit of positivity for the risk assets. But my observation over the years is that ultimately it's growth that matters. And if the rate cuts are happening in a slowdown cycle, then it does not necessarily have a salutary impact on risk flows. I think the fundamental requirement is growth, and if growth is slowing down, then you can see some volatility and some uncertainty for sure.
Got it. Now, just trying to figure out what happens sectorially, and I'll come to individual themes or individual ideas in a bit, because I see some of the changes that you presumably have made to your portfolios too.